Everyone else is watching, and they're seeing these big negative numbers, and their confidence gets affected.
They are ping-ponging back off each other.
People are seeing this, and those memories of fear are coming back.
And Gamble.
Proctor's trading at 60. What the heck is going on down here? I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
They say that investing is the key to wealth, but what if I told you there's a dark side? A side where fortunes are lost overnight, where Wall Street's finance manipulate the system, and where your biggest enemy might just be yourself. Welcome to the dark side of investing, where the truth you never wanted to know come to light. In this video, we're going to take a closer look at the less talked about side of investing, the psychological pitfalls, the behind the scenes manipulation, and the hidden risks that can catch even seasoned investors off guard. Stick around because understanding these can make all the differences in how you approach your investments.
Fucking shit. Unbelievable.
Let's kick things off with a look at the psychology of investing, because sometimes the biggest threat to your portfolio isn't out there, it's in here, your head. Overconfidence is a silent killer in investing. It's when you believe you have more control or insight than you actually do. This can lead to decisions like overtrading or failing to diversify your portfolio because you think you've got it all figured out. In the lead up to the 2008 crisis, many investors were overconfident in the housing market. They thought prices would keep going up until the bubble burst, wiping out trillions of dollars in wealth in just a matter of years. This brings up the bigger question. Have you ever been absolutely certain about a stock only to watch it tank? That's overconfidence at work. This overconfidence plays into the herd mentality. It's when you basically see everyone else buying or selling a stock and you feel compelled to do the same even if the fundamentals don't make sense. This can lead to bubbles or worse, crashes. The dot-com bubble is a classic example. Companies with no earnings, no business plan, and just a dot-com in their name saw their stock prices skyrocket until reality finally set in. And this leads me to ask you guys, the viewers, a question. Have you ever bought into a stock just because it seemed like everyone else was? Well, it's easy to get caught up in the hype, but it's often a dangerous game that can lead to classic examples like the dot-com bubble. This herd mentality leads into loss aversion, which basically is one of the strongest psychological biases. It's why people hold on to losing investments hoping they'll recover instead of cutting their losses and moving on. Think of a time when you held on to a stock that kept dropping, convinced it would rebound, but it never really does. It's tough to let go, but sometimes hanging on does more harm than good. The fact is I've been there too, holding on to a loser, hoping it would turn around only to watch it sink lower. It's painful, but recognizing loss aversion is the first step to overcoming it. To avoid these traps, always question your assumptions, diversify your portfolio, and don't let emotions drive your decisions. Investing should be based on logic, not fear or greed. With all these psychological impacts in mind, how can you protect yourself from these traps? The first step is awareness. Knowing that these biases exist is half the battle.
Money doesn't just buy you a better life, better food, better cars, better pussy. It also makes you a better person.
It's not just our minds that can betray us though. Sometimes the game is rigged from the very start. Insider trading is one of the dirtiest tricks in the book. It's when people with access to non-public information like executives and board members use that knowledge to make profitable trades before the information becomes public. It's like knowing the outcome of a game before placing your bets. This not only gives them an unfair advantage, but also erodes trust in the financial markets. One of the most infamous cases was Raj Rajaratnam. I don't know if I said that properly, but that's close enough. He was part of the Galleon Group who used insider information to generate millions in illegal profits. He was eventually caught and sentenced to 11 years in prison, but not before he had manipulated the markets to his advantage. Let's dive a little bit deeper. Imagine if you had access to tomorrow's headlines today. Sounds tempting, right? But insider trading isn't just unethical, it's illegal, and the consequences can be severe as seen with the Galleon Group. Beyond insider trading, this often leads to market manipulation. Market manipulation involves artificially inflating or deflating the price of a stock or other security for personal gain. This can be done through a variety of tactics, spreading false information, executing large trades to create the illusion of demand, or even colluding with other traders. The goal is to mislead investors into making decisions based on false perceptions, ultimately leading them to buy or sell at the wrong time. A great example of this is the GameStop saga in early 2021. It's a recent example of market manipulation on both sides. Retail investors on Reddit's Wall Street's Bets coordinated to drive up the stock price, squeezing out hedge funds that had shorted the stock. While some made huge profits, others were left holding the bag when the price eventually collapsed. To end this market manipulation segment, think about the frenzy of the GameStop situation. What started as a grassroots movement quickly turned into a high-stakes game where the rules were constantly changing. Market manipulation created chaos, leaving everyday investors at a severe disadvantage. Our next big issue is conflicts of interest. Conflicts of interest occur when financial advisors, brokers, or analysts stand to benefit personally from the recommendations they make to their clients. Instead of acting in the best interest of the investor, they might push products that earn them higher commissions or suggest trades that align with their own financial incentives. This can lead to poor investment decisions and erodes trust in financial institutions. This conflict of interest leads us back to the 2008 financial crisis, where mortgage brokers were often incentivized to push subprime loans that were riskier for borrowers but more profitable for the brokers. These loans were then bundled into mortgage-backed securities, where then were given higher ratings by agencies with their own conflicts of interest. The result? A global financial meltdown that could have been avoided if those involved had acted ethically. This brings up another great question. Have you ever wondered why certain financial products are so heavily promoted? It's not always because they're the best option for you, but sometimes it's because someone else is making a hefty commission behind the scenes. So how can you protect yourself in a market where the odds might be stacked against you? And they very much are. The key is staying informed and skeptical, and don't take anything at face value.
Enough of this shit'll make you invincible. Able to conquer the world and eviscerate your enemies.
After looking at some dark sides of investing, we need to look at the hidden risks and pitfalls. Even when you think you're playing it safe, there are dangers lurking in the fine print. Let's take a closer look at some of the hidden risks and pitfalls that can quietly erode your returns and put your investments at risk. So we have all these hidden risks and pitfalls, but what are these hidden risks and pitfalls? Well, the first hidden risk is the hidden fees. They're basically like termites that slowly eat away at your returns until you're left with far less than you're expected. These fees can be buried in the fine print of mutual funds, ETFs, and other investment products, making them easy to overlook. Over time, even a seemingly small fee can add up to a significant amount, especially when compounded over decades. Now, let's just say hypothetically, or for an example, let's just say, you're investing in a mutual fund with an expense ratio of 1.5%. It might not sound like much, but over 30 years, that fee could cost you tens of thousands of dollars in lost returns. Many investors are shocked when they realize how much these fees can impact their bottom line. Let's ask the bigger question. Have you ever really looked at the fees associated with your investments? It just might be the time to take a closer look, because those small percentages can make a big difference over the long term. So we have these hidden risks, but what are the pitfalls? One of the pitfalls could be leverage. It's a double-edged sword that has the potential to amplify your gains, but it can also easily magnify your losses. Trading on margin allows you to borrow money to increase your investment size, but it also increases your risks. If the market moves against you, you could lose more than your initial investment, and you might be even forced to sell assets to cover margin calls. It's like playing with fire, use it wisely, or you could get burned. Consider the case of leverage ETFs. These products are designed to provide a multiple of the daily performance of an index, but they're not meant to be held long term. Many investors didn't realize this and ended up losing significant amounts of money when the market turned against them. It's a stark reminder that leverage is a tool for professionals, not for the average investor. Leverage can be tempting, and it's the promise of big rewards, but have you ever considered the risks? Sometimes the potential losses far outweigh the potential gains. Beyond leverage and margin, there's misleading marketing. Misleading marketing can make risky investments look like golden opportunities. Financial products are often advertised with promises of high returns, low risk, and guaranteed income. However, the reality is often quite different. These ads can downplay the risk involved or omit important information, leaving investors unaware of the potential downsides. It's crucial to look beyond the marketing and understand the true nature of what you are investing in. Once again, circling back to the 2008 financial crisis, during the real estate boom, mortgage-backed securities were marketed as safe investments. They were given high ratings by credit agencies, leading investors to believe they were low risk. But when the housing market collapsed, these safe investments turned out to be anything but contributing to the global financial crisis. To protect yourself from hidden fees, always read the fine print. Look at the expense ratios of your mutual funds or ETFs and consider whether the returns justify the costs. When it comes to leverage, be cautious. Only use it if you fully understand the risks and have a clear strategy in place. And with marketing, always do your own research. Don't take advertisements at face value. Dig deeper to understand what you are really investing in. The financial world is full of pitfalls, but by staying informed and vigilant, you can avoid these traps and protect your investments. Remember, the devil is often in the details. So what's the takeaway from all of this? The dark side of investing is very real, and it's more pervasive than many realize. But the good news is, with the right knowledge and mindset, you can navigate these challenges and come out on top. Understanding the psychological traps, unethical practices, and hidden risks we've discussed is your first line of defense. Awareness alone can help you avoid the common pitfalls that trip up many investors. It's about recognizing that these forces are at play and being mindful of them as you make decisions. For instance, simply knowing about overconfidence bias can help you double check your assumptions before making a big trade, and as well as being aware of potential conflicts of interest can help you tremendously. Next, always do your due diligence. Investing isn't just about picking the hottest stock or following the latest trend. It's about thoroughly researching where you're putting your money, understanding the companies you're investing in, know the fees you're paying, and be clear about the risk involved. If you are leveraging your investments, make sure you have a solid plan and a risk management strategy in place. Think about the investors who avoided the worst of the 2008 crisis. Many of them weren't just lucky, they did their homework. They questioned the safety of mortgage-backed securities and saw the risks others ignored. Their diligence paid off when the market collapsed. Thirdly, skepticism is your friend in the investing world. If something seems too good to be true, it probably is. Don't take marketing claims at face value, and don't be swayed by the herd. Instead, rely on data, research, and sound judgment. Question everything, especially when it comes to investments that promise high returns with little to no risk. Finally, focus on the long term. The dark side of investing often preys on those looking for quick wins, whether it's through psychological traps, manipulation, or risky products, but true wealth is built over time, with patience and a steady approach. Don't let short-term market fluctuations, fear, or greed dictate your strategy. Stick to your plan, keep your emotions in check, and remember that investing is a marathon, not a sprint. Consider legendary investors like Warren Buffett. His success didn't come from chasing the latest trends, it came from investing in solid companies with strong fundamentals and holding them for the long haul. His ability to see beyond the noise of the market and focus on long-term value is a key reason for his enduring success. If you found this video valuable, give it a thumbs up and don't forget to subscribe for more insights on how to invest smarter and safer. Share your own experiences with the dark side of investing in the comments below. What traps have you encountered and how did you overcome them? Remember, the world of investing is full of opportunities, but it's also full of risks. By staying informed, doing your homework, and thinking long term, you can avoid the dark side and make your investments work for you. Thanks for watching, and I'll see you guys in the next video.